addirittura mi pareva che il grafico arrivasse fino al 2022. Proseguendo sulla nostra carrellata internazionale di personaggi internazionali, io darei la parola a Charles, e il cognome non mi avventuro a pronunciarlo, quindi lo chiameremo amichevolmente Charles, che è l'ideatore del mercato dei derivati, dei futures negli Stati Uniti. Lui fa parte del Director Commodity Research.
He is part of the Director Commodity Research and Product Development, comes from Chicago.
Come funziona il mercato dei futures?
And he's here today to tell us how the market or dairy futures work and which are the necessary relationships which must be developed to have a future market. I believe this is going to be very, very interesting, and most likely this is the future. That is what is going to happen in Europe soon, and in Italy as well. Thank you very much, Charles.
Inviting the CME to present to you this morning dairy risk management and the use of dairy futures and options products. CME Group consists of a number of exchanges. We have the Chicago Mercantile Exchange, and through mergers and acquisitions over the past 5 years, we have acquired the Chicago Board of Trade, the New York Mercantile Exchange, the Commodity Exchange, and the Kansas City Board of Trade just last year. So what type of products does CME Group offer? We offer commodity risk management products. We offer interest rate products, foreign exchange, equities, alternative investments. And when I speak of alternative investments, that would be housing indexes as well as weather products. Weather products we have would be temperature-based and precipitation-based and hurricane products. We also offer energy products and metals products. So what type of risk exposure do you have? I'm assuming you probably have commodity price exposure, energy costs, financial portfolio risk, currency risk. So what am I going to talk about this morning as far as risk management using dairy futures and options? I'm going to talk about protection. I'm going to talk about opportunities that you have with futures and options, liquidity that the futures and options provide, the efficiency of markets, and the variety of uses that you have with futures and options. So let's look at protection. Here's milk volatility going back to January 2007 through April 2013. As the past presenters have shown, there's quite a bit of volatility. We just saw in whey prices. This is milk price. And as you can see, dairy futures and options will help smooth out this volatility. It's human nature to want to buy low and sell high. So let's talk about market risk summary. So you have the risk, which was that volatility in my previous slide, going up and down. Let me go back here. Going back to the volatility, you can see we've had volatility ranging anywhere from 5% all the way up to 75% throughout that time frame. So what do you want to do with that risk? Well, first thing you want to do is you don't want to fear it. You want to be able to manage that risk that's going up and down, that volatility. You want to be able to accept it, manage it, and then conquer it. Because one thing to remember is if you don't manage your risk, you're assuming that risk internally in your company. And if you're assuming that risk, you're speculating. So you're just following that chart going up and down over time, not knowing where you're going to be as far as locking in a price. So what type of market risks are there? On the dairy future side, You have higher, markets can be moving higher. Markets can be just stagnating. They can just be going along with no change, or they could be going lower. And then on the cash side, what you're doing in your day-to-day business, the markets could be getting stronger. There could be no change in price, or the market could be getting weaker. But these two things are not working individually. They're working together. So on the future side, you may have prices going higher. And on the cash side, there may be no change. Or it may be getting weaker. Or they're both getting stronger or going higher together. So you have all sorts of moving parts that's involved in market risk. So while you think it's just prices going up and down in one sector, saying in the cash market, it's doing something else in the future side. So you have to protect yourself both ways. So the impact of risk. The greater the volatility in that previous chart, where it's going from 5% to 75% over time, then there's the greater the risk. Then the greater the need to manage that risk. So what is it about? It's all about risk, managing that volatility in the dairy markets. So simply stated, it's your bottom line. It's your cash market position. What's happening in your business day to day? How are you going to manage what's going on with that volatility? And when you're using futures and options and you're tying that together with the cash market, what you're doing is you're able to focus on your core competencies within your company. So what you're doing is you're taking out price risk so you can focus on other things. Your company can be focusing on better marketing, better strategic planning for your company. You're also smoothing out your cash flow from month to month by using dairy futures and options. So what is a futures contract? It's a legally binding agreement to accept delivery or make delivery of a standardized quantity and quality of a commodity to a standardized place in a standardized time period for a price discovered on an organized exchange. Now this is for a delivered product. When I say delivered, if you were to enter into a futures contract and let it go to expiration, like in our corn contract at a CBOT, then you would be taking delivery of corn. But with the milk futures at the CME, they're cash settled, which means that you do not take delivery of milk or make delivery of milk. They settle financially, so all the transfers back and forth between buyer and seller is a cash difference. Here's the Class 3 milk at the CME, the contract specifications. The size is 200,000 pounds, or 90 metric tons. The price is in U.S. cents per hundredweight. A tick symbol, that's the amount that the contract can move. The minimum is a penny, which equals $20 U.S. dollars per contract. The ticker symbol is DA, and that's an open outcry. That's when it's traded on the floor, and you see the brokers on the floor waving their hands and things like that. That's open outcry. And we also trade it on Globex. We have a daily price limit, so when you enter into a futures contract, you know that the daily limit is going to be 75 cents for that contract on either the upside or the downside. So you know that that's all that contract is going to move for the day. And then it resets the following day, and it can move another 75 cents up, or it's another 75 cents down, or somewhere in between. We list 24 consecutive contract months. Position limits are 1,500 contracts in any contract month, so over 24 months, you can have 1,500 contracts in each of those months. We trade it electronically and in open outcry. Cash settled cheese contract, 20,000 pounds, same thing, U.S. cents. Now this product only trades on our electronic platform. It does not trade in an open cry environment, and we also trade 24 consecutive months. The reason why you see the contract at 20,000 pounds and the same daily price limits and the same tick size is that what people do is, what they're doing is spreading between the Class 3 milk futures and the cheese contract, because Class 3 milk in the United States is what's used to make cheese. So as you get familiar with futures and options, there's all sorts of strategies that you can use to minimize your risk. So price risk management, you have your cash price in the European market, and then you have futures and options. I know Eurex offers a number of dairy contracts, but they're not that liquid. They don't trade that often, and so forth. So what's happening is instead of having a balance, as in this scale, you're having it off kilter, whereas it's heavily weighted on the cash market. So you don't have futures and options to help balance out that risk that you're facing every day, every month, every year. So with futures and options, you can balance that scale so you can go back and minimize your risk. So the hedging mechanics of risk management. Most cash markets and futures markets move up and down together. So what's happening in the cash market is being analyzed in the futures market as well. And what's being analyzed in the futures market is projecting what's happening in the cash market. I hope that makes sense. Because it's all about information, pricing information. And when you know what's going on, or you have something to look at in view of what's taking place in the future, you can have a better idea of where milk prices will be going or product prices. So when you're hedging, what you want to do is you want to take the opposite position in the cash market than what you're doing in the futures market. And I have some examples on that. So once you're put on your hedge position, a loss in one market is offset by a gain in the other market. Regardless of the price direction, the result is the same. So let's take an example of a short milk hedge. Short means a selling. You're selling milk in a falling market. So today, May 24th, the cash market is showing that milk is at $19.30 a hundredweight. The futures market is showing that the price is $17.80. So the market's going down. And your basis is $1.50. Basis is the cash market minus the futures market. So time goes on, October 15th rolls around, you're selling milk, and you sell milk at $17.30. So the market went down, you're $17.30. What you did in the futures market was you sold a November contract at $17.80. And on October 15th, when you sold your milk in the cash market for $17.30, you simultaneously bought back your futures contract at $15.80. And your basis stayed the same. So you had a $2 per hundredweight gain on your futures position, but you lost on your cash market position. So you sold the milk at $17.30, but you had your $2 gain on the futures market. So in the end, you ended up on October 15th selling your milk for $19.30, which was the market today. So even though the market went down, by the use of futures, you were able to maintain that $19.30 per hundredweight. So in that first graph that I showed with the volatility going up and down, by using a futures contract, you were able to maintain a $19.30 per hundredweight for that milk. So let's take an example of a short milk hedge. You're selling milk again, but the market is rising. Again today, the cash market is $19.30. The futures market, you sell a November contract at $17.80. Your basis is the same, $1.50. So now October 15th rolls around. Milk is at $19.55. So the market went up on you. And you simultaneously bought back your November futures position at $18.05. So you have a 25-cent loss on your futures position. But you sold your milk at $19.55. You factor in your loss on your futures, but you still ended up paying or receiving $19.30 per hundredweight. Even though you didn't catch that high on October 15th at $19.55, you are better able to manage your risk throughout that time frame by receiving $19.30. But I know it's human nature to say, but I could have had that milk at $19.50. If I didn't put that futures position on, I still could have received $19.55. But again, you're going back to that volatility. You cannot catch the highs and the lows every time. That's where risk management becomes a tool for your organization. So what do you see? Risk or do you see opportunity by using futures and options? Well, I hope you said you see opportunity, because this is going to be a short presentation. So with opportunity, I'm going to introduce to you the options market. And an option is a contract between two parties that convey a right, but not the obligation, to buy or sell a specific commodity at a specific price within a specific time period for a premium. The way you want to look at options is it's an insurance program. You have car insurance, you have home insurance. Options are an insurance policy. So what types of options are there for you to use in your risk management? You have calls, and that contains the right to buy. And this is used to establish a maximum cost for your dairy input. So if you're a cheese manufacturer, you can establish a maximum milk cost that you're going to pay for that milk over time. We have puts. That contains the right to sell. So what you can do is you can put a floor on your output. This can be used by a dairy farmer. The dairy farmer can use a put to establish a minimum milk price that he will receive through the use of selling a put option. So no matter how far that market goes down, if he went in and bought a put or sold a put, he's going to be guaranteed that no matter how low that milk goes, what he put that strike price in for that milk, that's what he's going to receive. So let's look at a variety of what you can do with futures and options. On a buying strategy, you can go in and you can use a long futures to lock in a purchase price, like I showed in that previous example. Or you can go in, and when I say a long futures, what you're doing is you're buying. Long is the trade term for buying, short is for selling. Or you can buy a long call, and that's going to lock in the maximum purchase price. So no matter how high milk price goes, if you bought a call at a certain strike price, you know that that's the amount that you're going to get paid for that milk, or you're going to pay for that milk. Or you can use a combination of a long call and a short put to lock in a range. So no matter how high milk goes or how low milk goes, you're going to be guaranteed to be within that range that you're comfortable with, that your organization has decided that this is where we feel that we can make a profit if we lock in prices between these two price levels. So the top three examples would be for a manufacturer. Or that manufacturer can go in and do a structured maximum price contract and offer that to their dairy farmer where they're receiving the milk from. They can go in and talk to the dairy farmer and say, we're going to go into a long-term purchase agreement with you to buy your milk, but we're also going to put in a long put option. We're going to go in and buy an option so that no matter what that milk price does, you're going to be guaranteed that floor for your price. So what that does for the dairy farmer is that will allow the dairy farmer, if they want to expand their herd, they want to buy machinery for the farm, they just want to expand, they want to buy more land, they can go into their lender, their bank, and say, okay, I'm using risk management, I'm guaranteed to be receiving this amount of this price for my milk over the next 6 months, 12 months, 24 months. So now that the banker will feel more comfortable in lending to that dairy farmer because they know that they're going to have a guaranteed income by using futures and options. Or the manufacturer can use a basis contract, which is a futures minus the cash market and then go in and buy a call. So there's different strategies that you can use to protect yourself as a manufacturer, to help your dairy farmer that you're buying your milk from. So there's different ways. So on the sell side strategy, you can go in and you can sell a futures or short a futures position and lock in a price level. Or you can go in and buy a long put and lock in that minimum price level. Same thing again, you can go in and buy a put and sell a call to put in that range that you're looking for. And again, you can go in and use, to help your dairy farmer, a minimum price contract by going into the cash forward, using a cash forward contract and a long call option. Or again, using a basis contract with a long put. What I'd like to talk about now is a little liquidity and why it's important to have liquidity in futures and options contracts. Here are some key dairy contracts. Our Class 3 milk futures contract. It trades about 1,100 contracts a day. Our open interest on the future side is about 28,000. On our milk options contract, we trade 1,200 contracts a day. And our open interest is 68,000. It's probably closer to 70,000 today. Our butter futures, we trade 130 contracts average daily volume. And the open interest is about 7,500. Our cheese futures contract, which is our newest contract that we launched probably about 2 or 3 years ago, we're trading 251 contracts a day, and we already have combined open interest of 13,400. What's important about liquidity and open interest and volume in any futures contract is the ability to get in and get out of the market. So if you go in and you buy a futures position or you sell a futures position, you want to have that liquidity there. You want to have that daily volume high so that you can get in and out of that contract. And when I say you want to get in and out of that contract, you want to make sure if the contract's illiquid, which means that it doesn't trade very much, if it's trading 10 contracts a day, 5 contracts a day, you have a bid and an offer. And a bid is what you're willing to buy and someone is willing to offer it at. And if that bid and offer is very wide and you got in early on and you want to get out and that market is quoted, let's say 50 ticks wide, now it's called slippage. You have to either take a loss to get out of that contract because the market's illiquid. Nobody's going to want to sell you a contract or buy your contract back from you when the market is that illiquid. Because then you're going to have to give up some of that gain to get out of that position. Or if you're losing, you're going to have to lose a little more because somebody knows that the market's going down and they're going to be assuming that risk. So you have to remember, when you're buying and selling futures, there's someone on the other side of that contract that took that because they had the opposite position of you. They thought that you think the market's going up, they think the market's going down. And then that brings up the topic of speculators in the market. And everybody thinks that having speculators in the market are bad. Speculators are the ones that provide that liquidity for you, that tighten up those markets, that bid and ask spread. So that's what speculators do in the marketplace. They're making that market more liquid by assuming that risk that you want to offset in your business. Let's talk a little bit about efficiency with futures and options and some concerns you may have and possible solutions with futures and options. So you're concerned about a drop in your inventory. Let's say it's cheese, let's say it's butter, it's whey. What you can do is you can go in and you can sell a futures contract at today's price because you think that there's going to be a drop. So you're locking in your inventory at today's price. Or you can go in and you can sell a put option, the same thing, to lock in that price of your inventory. If you think that the volatility is going to pick up in the market, be it cheese, butter, milk, and you're not sure which direction it's going, you can go in and use options to protect yourself. And again, an option is a little bit different than a futures, is because you get to go in and you get to pick the day that option will expire, and you get to pick the price that you want for that option. Whereas with a futures contract, it's that price that's going on right now at the market. Whereas an option is like an insurance policy. You can go in and say that you want to insure your car for $10,000. You're picking that $10,000 value. That's the same thing with an option. You're picking the value of your inventory where you want to manage that risk at. So in the top, this is called a long straddle. You're buying a put and you're buying a call because you're not sure which way volatility is going to go. So you buy and in this example, it's a strike of 60. So as you can see, you have between about 54 and about 66. And when you bought this option, underneath that zero is that premium that you paid for that protection. Because once that market starts moving in either direction, once it gets over 66, the person that took the other side of that option is now going to have to pay you because he insured you for those prices. Same thing if the market starts going down. A long straddle is similar to, the strangle is similar to the straddle, but what you're doing is you're widening out and you're buying not at the money options like you did in the first example, which was 60, that was at the money. Now you're buying out of the money option, so you can assume a little more risk by buying it at 65 and buying it at 55 and then letting the market go up from there. Now let's say you want to improve your market share in a stable market. Now these positions are opposite of what you're doing. Now you're becoming the insurance agent because you think the market's stable and the market's not going to move over time. So you're going to be writing these options and taking that premium in as cash. Because you feel the market's stable, I can take that money and use that for something else. But you have to be careful by doing that, because if these markets start moving, you're on the insurance side. You're the insurance agent. You're going to have to pay the other person once these markets start moving in the opposite direction. And again, you have the short straddle. That's a little more riskier because that's at the money. Those are at the money strikes where the market is currently. And a short strangle is outside the money, out of the money options that you're writing. Now, what if you're unsure about the market? Well, here's what you can put a collar on. This is where you sell a call and buy a put. So what you're doing is, again, you're selling that call so you know that once the price moves to 65, that's where it's going to be locked in. So if it goes up to 70, you're still going to be getting 65. You'll be receiving that. Or if the market starts going down and it gets to 55, where you bought that put, you know that no matter how low the market goes, you're still going to be receiving that $55 or for your product. And if you're not sure which contracts to use, remember liquidity. You want to know which contract has the most liquidity in it, which is trading the most every day so that you can get in and out of your position. You want to remember transparency. You want to be able to remember. You can see those prices every day. You can see those prices every second as they move. And at CME, we have something on our web page that you can go in and you can look at the dairy markets and you can see what the futures market is trading. They're called real-time quotes. And you can see what's happening in the milk market. You can see what's happening in the cheese market or the whey market or the non-fat dry milk market at the CME. Other markets, you may have to wait weeks to see what's going on before you can get pricing signals. So those are some of the things you want to remember when looking at which contract you should use. Another thing you should look at is correlations between products. In the United States, we have the cheddar cheese contract, the standard cheese that we have. Well, there's people in the U.S. that also produce mozzarella cheese. So they say, okay, the CME doesn't offer a mozzarella contract. So how can I use the CME markets, dairy markets, to hedge my mozzarella cheese? Well, they look at the correlation between the price of mozzarella and our cheese market and how those two move together. And they look at the correlation and they say, well, the two are correlated 80 to 85%. And they figure that that's manageable risk. They can take that 20% or that 15% difference in correlation, and they'll use the cheese contract to hedge their mozzarella cheese. So correlation is very important in a futures contract as well. Because if CME or any exchange were to list a mozzarella contract or a Parmesan contract, what you're doing is you're dividing that liquidity, because people are only going to use that contract. They're going to say, well, I make mozzarella, so I'm going to use mozzarella. So you're taking liquidity out of one contract and spreading it across many. And when you do that, the markets become illiquid. So, all right. So again, correlation is important. So, I was coming to the end anyway. Quickly, variety of products, futures and options, the cheese, the non-fat dry milk, dry whey, etc., butter. Flexibility of uses. You can use a futures, you can use an option, you can use a combinations, buying puts, selling calls. Liquidity and transparency. Regulation and financial integrity. Regulation, we're governed by the CFTC, the Commodity Futures Trading Commission in the United States. The contracts are solid. Choice of trading platforms, open outcry, electronic trading, customer care. Here's some other contracts I have that's on, you're going to be able to view as well for our butter and our options contracts. Customer care, my contact information in the United States, the gentleman that I work with on the commodity base side, and our director based in London. Thank you.
Grazie Charles. Uno strumento che...
Thank you, Charles. An extremely interesting instrument, which also might be considered as a possible solution, as an adequate solution we might use to come to terms with these price swings, which also hinder investment planning. So this is the most serious thing for a company. Like, you are not sure about what you are doing because you're not investing because you don't know what is going to happen tomorrow, whether you're going to lose or to win.